Hey guys, welcome back to another episode of Finance Focus Financial Fridays. How many of us find ourselves overwhelmed or struggle to keep up with debt payments every month? Did you know that an option to free up cash could be debt consolidation? However, it's important to understand how debt consolidation works and, if we choose it, how it could benefit us in the long run. Let's find out. It is important to keep in mind that debt consolidation is not a solution to poor financial habits. We still have to address things like our money mindset, our financial discipline, overspending, budgeting, and a debt repayment plan. All of these apply to our financial wellness whether we choose to consolidate or not. The reason being, we may consolidate our credit card debt, max them out all over again, and now we're in double debt. Nerdwallet.com also shows that the average person leaves behind debt after death. Will that be you? Did you know that having life insurance can safeguard your family from inheriting your debt after you die? Having insurance can be used to cancel debt like mortgages, payday loans, and credit card debt. And also, if you have land, it can also be used to pay the transfer fees. For business owners, debt is a part of entrepreneurship. Having insurance can ensure that if the owner dies, their legacy lives on for their business. Want to know how? Contact Brenton Hiller at Surgical Life EC for more information, who happens to be the sponsor of today's episode. So how does debt consolidation work? The idea behind it is that you take all your different debt obligations and you lump them into one large package. So instead of having multiple monthly payments to different creditors, after you consolidate the debt, you only have one reduced monthly payment, and on top of that, it's at a lowered interest rate. However, proceed with caution, as with consolidating debt, it may cost you more in the long run. So today I'm going to help you to decide if debt consolidation is right for you, and if you have already consolidated some debt, if you considered everything. The first thing you'll need to do is determine how big of a loan you need to take to pay off all this debt. And they don't only work for credit cards. You can consolidate mortgage and land and vehicle and even hire purchase. Then you'll want to shop around for the right loan. This is important because different lenders have different rates and loan periods. Trust me, it's worth the walk. Get quotes from different lenders. Now, when you approach a lender, you'll want to ask these key questions to gauge if you can actually afford the loan. What will be the total cost of a loan? And that includes the principal, the total interest charges, and fees, so that you can compare the cost savings with other solutions. You want to know the monthly payments and the number of payments. For debt consolidation to be truly beneficial, you'll want an interest rate that's lower than 10%. Next, you'll want to know when and how you'll get the funds and when is your next payment date. This matters because you may need to make certain bill payments in the interim. Let's say your bill is due on the 5th, but the lender will only disburse on the 8th. Then you'll have to make a payment to avoid late fees. The timing could also impact your cash flow depending on when your payments should commence. You'll also want to know if they plan on disbursing the funds to your account or directly to the creditors. I don't know about you, but I would like to know if I could pay off that loan without any penalties or fees. Always make sure that you know the payoff fees to close off the loan. You don't want to incur high extra costs just because you're trying to pay off your loan quickly. Now, after you've gotten all this information, you need to ask yourself this one very important question. Would these new payment terms put me at a disadvantage in the long run? Choosing the longest repayment term will give you the lowest monthly payment possible. But it also means that you're in debt longer and you would have to pay higher interest charges down the line. You want to pay off a consolidation loan as quickly as possible. So when it comes to paying off a consolidation loan, you should put the new installment into your budget. Build an emergency fund to avoid incurring debt again on your credit cards or taking payday loans. Don't make any charges on your cards until you've paid off the loans. I know it might be tempting, but think about your financial goals. So, is debt consolidation a good idea? Yes, it frees up cash to achieve other financial goals. I hope you enjoyed this episode on debt consolidation. Don't forget to subscribe to the YouTube channel for more videos. Later, dudes.